Swaminathan Aiyer, consulting editor with ET now joins us now. Swami, good morning. Thank you for joining us. Swami, if I have to put in simple terms, the Prime Minister announced the CTC package, what the Finance Minister has given essentially after tax and after bonus consideration in hand. There are deep structural reforms which the Finance Minister has announced. Those are good, important, and they have been compared by 1991. But in the short term, the priority is to stimulate demand by just increasing the expenditure by 1%, that too in the second half of this year. Do you think demand is not going to come back? What is your sense on the complete package now?
You're absolutely right. Demand is not going to come back. This is not a stimulus package. A stimulus package is something that would increase GDP. I mean, I saw Pranab Sen's latest forecast that GDP will fall 9%. I mean, I would say perhaps not that much, maybe fall 3 to 5%. But whatever is happening, we are facing economic collapse. So please, whatever you call it, don't call it a stimulus. You might at best call it a sedative. You might say that when the patient is crashing, I am trying to ease the pain a little. That's what we have achieved. But in terms of aggregate demand, the one you are referring to, no, sir, aggregate demand is collapsing. Even at the time when supply itself is collapsing because the lockdowns have interrupted all kinds of production chains. So I would say the outlook is very grim. I am glad that Mr. Modi has seized this opportunity to try and push through long-term structural reforms, which the country badly needs. And I'm glad that he is not wasting a crisis. But if you ask me what is going to happen in the rest of this financial year may be one of your worst or the worst in Indian economic history.
So Swami, where do we go from here? One side you've got a short-term challenge, but the medium-term visibility and the long-term challenges, at least on the supply side, they're getting addressed, whether it is on the power front, on the land front, on the labor front. You've always argued that India had an inherent disadvantage because of high cost of capital, because of land reform, because of no land reforms and no labor reforms. Are things progressing in the right direction, which is that you'll have to go through the short-term pain in order to increase your immunity and for a better long term? Is that the way we should look at it?
I mean, this is what I have been recommending for a long time. Finally, it seems that Modi, Sitharaman are going in that direction. Whether they will be able to follow through, I don't know. In many of the cases, you see, there is no point saying, for instance, I'm suspending labor laws for 3 years. What happens after 3 years? What is the point of suspension? You need to change the law. Again, what happens if the opposition comes to power and reverses it? So in some sense, after 1991, the reform process started by the Congress party. Everybody else followed in the same direction. Right now, Mr. Modi is trying to start a similar process. We don't know whether everybody else will go in that same direction. We can only hope that he does. I would simply say this. The short term, the world is facing an enormous, huge recession, and India cannot escape unscathed, whatever it does. So whatever it does, there was going to be trouble. This particular package of 20 trillion, it is a highly exaggerated figure by adding pledges, promises, long-term things. The actual stimulus, the fiscal stimulus, as you said, is perhaps no more than 1% because they are afraid of downgrading by foreign rating agencies. I simply say that if you say Atmanirbhar, self-reliant, a self-reliant country cannot be in total funk of foreign rating agencies. At the end of it all, we are better off than a whole lot of other emerging market economies that have not been downgraded. So I certainly would have gone for a much larger immediate fiscal stimulus. I would not have been afraid of letting the RBI, one way or the other, monetize that particular deficit. I would have stood up to the risk of downgrading. And I would even say that, if I'm mainly trying to attract FDI is not dependent on credit rating. I don't want hot money. So I would certainly have said that we needed to have a bigger fiscal stimulus. Mr. Modi has turned out to be too cautious on that particular front. Because of this, I think we are going to have a deep and painful recession, and there is no way this so-called stimulus package is going to stimulate. This patient is being sedated. The silver lining is the medium-term reforms, which might not have happened without a crisis. So perhaps at the end of it all, we are going to have a terrible year this year. I don't guarantee that there's a quick snapback next year either. But if you look beyond that, I think, the prospects have become better. That Mr. Modi has decided that the incrementalism of his first term was not enough. This time I'm going to go for more radical reform. That is a courageous and right direction to go in, even if it takes some couple of years for the results to begin to show up.
We'll just put a graphic out, which is that the credit guarantee, what different companies have announced in terms of credit guarantee. We love to compare other developed markets with us, but I'm going to simply compare developed markets, emerging markets, and India. The credit guarantees which have been extended by some European nations as percentage of the GDP, that number in Italy is at 32%, but it's a different financial system, very welfare-driven state as well. Then in Korea, it is 6.4. In Argentina, which is bankrupt, it is 1.2, and India is about 3%. So on the credit guarantee fund, as percent of GDP, we've got some uptick. On the discretionary spend as percentage of GDP, this Goldman Sachs approximation, other emerging markets are spending 3.9%, world is spending 6.2%, India is spending 1.3%. So Swami, that brings me back to that point, which is that as percentage of the GDP, we are only spending 1.2, 1.3%. Given that 60% of Indian economy is a consumer-driven economy, and we are not China, which is a consumption stroke and which is an investment-driven economy, 60% of the economy needs help, and that's where the money is not going to come.
Exactly. I mean, you are echoing, in fact, my sentiments that the government should have gone for a much larger spending package directly, sending money directly out, which could be spent to sustain and improve the economy. And because it has not done so, I think the recession is going to be much deeper than otherwise. So we are taking a big hit in the current financial year, much bigger than I think need be. And I think partly it is out of fear of a downgrade, which I would have taken the risk. So I think, in effect, Mr. Modi is saying, I'm spending so much money on helping all of you out, and little driblets here, there, and for every sector of the economy. And he hopes that the public will take this particular punch on the jaw. They will say, well, it's not Mr. Modi's fault, it's the coronavirus's fault. And after that, things will get better. Now, it's a risky political move for him to take, but he does not have any state elections coming, except the Bihar election, where the opposition is so weak, I think it's a foregone conclusion they'll come back. So I think Mr. Modi has taken a deliberate risk of saying, instead of my going for a spending boom right now, which might affect my fiscal deficit to GDP, my debt to GDP ratio in the next year, downgrading those issues, let me take a very, very big hit this year. I'll take the very big hit this year, and then bounce back later. I think this is the calculation, and it is a political calculation, no less than an economic one. Some might say it's a courageous thing that I will take a really big hit this year and then bounce back much better later on. All I can say is that I personally would have gone for a much bigger spending package this year.
Swami, the ratings downgrade, I know it's crucial because we are a capital-starved economy and we need capital. But if countries like Italy and Spain, where the bond ratings are not great, and if Greece can attract capital, do you think this entire obsession of what rating agencies would do is very, very crucial? And frankly, Swami, in equity market, MSCI benchmark, it's an important benchmark, but fund managers are not obliged to follow that benchmark. I mean, if you're a foreign investor, you pretty much know that you can come to India and invest irrespective of the rating downgrade or upgrade, because India has got forex reserves and the balance sheet tells you that India as a country will not go belly up.
I would entirely agree that we are being unnecessarily funky on that particular part. If you go back to the taper tantrum 2013. I mean, at that particular point of time, the Indian economy, the macroeconomics was haywire. Inflation was sky high. Our current account deficit was 4.5% of GDP. And in those circumstances, we took a terrific hit. Today, that is not the case. Inflation is under control. Our foreign exchange reserves are stable. We are in a position, we are more resilient than the vast majority of developing countries. We are in a position to take the hit. Not only that, now the IMF projections by now have become out of date. But when they did their revision and said, okay, world economy is going to be sinking, everybody will go down, and India will go down from whatever they were expected, 7% to 1.9. The IMF estimate of 1.9 at that particular point in March was the fastest of any major economy in the world. In other words, the IMF is giving its own certificate that, even when things are very, very bad for the globe as a whole, India will be one of the best performers. Given that, where else is the foreign investor going to go? Is he really going to rush into America where the treasury rate has gone down to zero? When is that where you're going to go? Speculating that it will become negative. Some of that money, I think, has to come to India. Anybody with a global portfolio cannot ignore the strengths of China and India in this particular position. And money will go into those countries regardless. Even if we have negative growth all over, negative growth is going to be there everywhere. So I would say we have funked this particular test. And to talk of Atmanirbhar and be so afraid of Moody's or Fitch is not a sign of self-reliance. It is not a sign of courage. At best, you could say that it's a very cold, cool calculation that if I take a bigger hit this year, I will have a bigger bounce back next year. And that there is no political damage because there are no elections to be lost. So let me write off the current fiscal year and go for a bigger bounce back next year. I think this is possibly a defense of what they have done. I certainly would agree with you that we should not be worried about what the rating agencies say. And in any number of cases we have seen in the past, even when the rating agencies have been dubious, investors have rushed in. The prime example surely is Argentina. Here is this country which has already defaulted 8 times in a row and is now going to default a 9th time. 2 years ago, they were able to raise 100-year bonds, believe it or not. Why? Because they offer a higher yield. And foreign international investors are desperate for yield. So investors who are willing to invest in a 100-year bond in Argentina, can they possibly ignore India, even if we go for a big fiscal boost? No, sir. So in my view, we have completely funked the issue as far as foreign exchange and the rating agencies are concerned.
Well, Swami, appreciate your time. Thank you for a quick and lovely synopsis.